You ever find yourself just wondering, what's the economy going to do next month, next year?
Oh, constantly. It's the big question, isn't it?
Yeah. I mean, businesses are making these huge decisions. Markets are jumping at shadows.
And for everyone else, just trying to plan, you know? Do I save? Do I spend? Big stuff.
Exactly. It feels like we're all trying to read the tea leaves, just hoping for a tiny glimpse of what's coming.
Well, while there's no crystal ball, thankfully,
Thankfully.
there are tools. Economists, analysts, they use specific statistics, indexes, to try and get a bit of a clearer signal through all the noise.
Right, trying to find some pattern in the chaos.
That's the idea. To interpret what's happening now and maybe, just maybe, see the shifts coming before they hit us full force. They're like signposts.
Signposts, I like that. And today, we're going to really focus on one of the big ones, right? Here in the U.S., at least.
Yeah, a major one. The leading economic index, the LEI. It's put together by the Conference Board.
Okay, so that's our mission for this deep dive. We're going to unpack this LEI. What is it, really? What are the pieces inside it?
And crucially, how is it supposed to predict those big economic turns?
And what's it been saying lately? We've got some recent data from our sources, right?
We do. And we'll also step back a bit, look at the whole challenge of economic forecasting.
Yeah.
It's tricky.
I bet. So we're drawing on the Conference Board's own info, some analysis from places like Forbes, Investopedia.
And even some academic research looking at different forecasting methods. Get a rounded view.
Perfect. Okay, first things first. Let's lay some groundwork. Before we get into the LEI itself, what exactly are economic indicators and why are there different kinds?
Okay, good place to start. Basically, economic indicators are just statistics, data points. They help us take the pulse of the economy.
Like checking its vital signs.
Exactly like that. Production, jobs, prices, spending, how people are feeling. These numbers give us concrete measurements. And changes in those numbers, well, they can signal that things are speeding up, slowing down, maybe changing direction.
Got it. Quantifying the economic machine. And you mentioned different kinds. That sounds important for timing.
Crucial, yeah. Economists usually put them into 3 buckets based on when they tend to move relative to the overall economy, the booms and busts, the business cycle.
Yeah.
Those buckets are leading, coincident, and lagging indicators. Understanding this is really key to getting what the LEI is all about.
All right, let's walk through them. Leading means they lead. They come first.
You got it. Leading indicators are the ones that tend to change direction before the broader economy shifts. They're supposed to give you that heads up, the early warning.
Okay, like what? What are some examples?
Well, our sources mention a few classics. The yield curve is a big one.
Ah, yes, the yield curve. Everyone talks about that one.
Right. Specifically, the difference between long-term and short-term interest rates. When short-term rates go higher than long-term rates, that's called an inverted yield curve historically. That's often come before a recession.
Why is that?
The thinking is, it suggests bond investors expect growth to slow, maybe even shrink, which pulls down future long-term rates. It's a powerful signal, though, or there's always debate about whether this time is different,
Always. Okay, what else is leading? Housing starts.
Yep. No housing starts. Makes intuitive sense, right?
All right.
Builders are looking ahead. If they start building a lot of new homes, they're betting on future demand, a healthy economy.
And if they stop building,
Then they're getting nervous. It signals caution about the future, not just for housing, but often for the wider economy, too.
okay. What about asking businesses directly, like that PMI thing?
The Purchasing Managers Index, PMI, another key one. It's a survey. They ask purchasing managers in manufacturing services about new orders, production, hiring.
And if it's above 50, things are growing. Below 50, shrinking.
That's the general rule. And because these managers are dealing with orders coming in now for production later, their sentiment and activity often lead the actual output numbers.
Makes sense. And money supply, is that leading to?
It can be, yeah. Money supply. If there's more money and credit sloshing around, it tends to fuel future activity. If it tightens up, it can put the brakes on. It's complex, heavily influenced by central banks, but big shifts in money growth have often preceded economic shifts.
Okay, so leading indicators are trying to peek around the corner. What's the next type?
The second type is coincident indicators. These guys move pretty much in sync with the overall economy. They tell you what's happening right now, or very, very close to it.
So like GDP, that's the big one for now.
Exactly. Gross domestic product, GDP, is the prime example. Total value of everything produced tells you if we're growing or shrinking right now.
What else fits in there?
Things like personal income, but excluding government transfers. so it reflects income from actual current work and production. Also, payroll employment, how many people have jobs right now. And manufacturing and trade sales, current sales activity, they're snapshots of the present economic health.
Okay. Leading for the future, coincident for the present, which leaves lagging indicators. They tell us what already happened.
Pretty much. Lagging indicators change direction after the economy has already turned. They confirm a trend that's already in motion. Useful for analysis, seeing how deep a recession was, maybe, but not for predicting it.
Like the unemployment rate. It always feels like that gets better after things already started picking up.
Textbook example. The unemployment rate.
Yeah.
Businesses wait to see if a recovery is real before hiring back, and they often try to hold on to workers at the start of a downturn. So yeah, unemployment lags.
What else is lagging?
The consumer price index, CPI inflation, is often seen as lagging, reflecting past price pressures. Also things like how long people stay unemployed, labor costs, the average prime lending rate, they all tend to adjust after the fact.
Okay, so leading, coincident, lagging, different perspectives. But you said earlier, and the sources really hit this point, relying on just one isn't smart.
Absolutely not. Any single indicator can bounce around, give false signals. Maybe its relationship with the economy changes. You really need to look at them together. Use the whole toolkit.
Which brings us neatly back to the Conference Board and their composite indexes. They formalize that toolkit idea, right? Especially with the LEI.
Exactly. They create these composites, the LEI for leading, the CEI for coincidence, and the AG for lagging indicators. They track these consistently for the U.S.
But why mash them together? Why not just watch, say, 10 leading indicators separately? What's the point of the composite?
Good question. The main goal is to smooth things out. Individual stats can be noisy, right? Seasonal quirks, data revisions, maybe something weird happens in just one industry.
So averaging them helps filter out that noise?
That's the hope. By combining several indicators that should, in theory, move together ahead of the economy, you average out the individual jitters and hopefully reveal the underlying common trend, that turning point, more clearly than any single one could alone.
Like listening to a choir instead of just one singer who might be a bit off-key.
Yeah, that's a good analogy. It aimed for a more robust signal. And the Conference Board's own research shows that, historically, the turns in their LEI have tended to happen before the turns in the broad economy, which they measure with their CEI.
And the CEI moves with the economy, and the L leg follows after.
That's the historical relationship they point to. And they specifically say the LEI usually anticipates those big turns in the U.S. business cycle by about 7 months on average.
7 months. Wow, that'd be incredibly useful if it's reliable.
Okay, let's zoom in on the LEI itself, the U.S. version. You said it has 10 components. Let's tick through them. What are they and why are they leading?
All right, let's break down the 10 ingredients. First, average weekly hours, manufacturing.
We mentioned hours earlier.
Right. It's often the first thing employers adjust. Easier to tweak hours up or down than hire or fire. So changes here often signal future changes in production and hiring plans.
Okay, number 1, manufacturing hours. What's next? Number 2, average weekly initial claims for unemployment insurance. New jobless claims. Very sensitive. When businesses get nervous, layoffs often tick up fast, and it shows here immediately.
Before the main unemployment rate moves.
Exactly. It captures the very beginning of job losses. The index actually uses it inverted, so rising claims are a negative input.
Got it. Number 3.
Manufacturers' new orders for consumer goods and materials. This is measured in constant dollars, so it's about volume, not just price. New orders drive future production, right?
Yeah.
If orders rise, factories get busier later. If they fall, production slows down.
Makes sense. Leading production. Number 4.
ISM index of new orders. This is similar, but from that survey of purchasing managers we talked about. It captures their real-time perception of incoming orders, often faster than the official stats. Again, forward-looking demand.
Okay, what's 5?
Manufacturers' new orders, non-defense capital goods excluding aircraft. Think big machinery, equipment, the stuff businesses buy to invest in their own future capacity.
So business investment plans.
Precisely. Excludes volatile defense and aircraft orders. When businesses feel good about the future, they order this stuff. When they're worried, they cut back. Signals future investment activity, also in constant dollars.
All right, halfway there. Number 6.
Building permits, new private housing units. We touched on this too. Getting a permit is step 1 for building a house. It clearly points to future construction activity, jobs, demand for materials, appliances, reflects builder confidence.
Okay.
7, stock prices, S&P 500. The stock market. often seen as a collective bet on future corporate profits and the economy's health. Prices react fast to news and sentiment shifts.
Right. Always volatile, though.
Very. That's why it's just one component among 10.
Yep.
Number 8 is the leading credit index.
That sounds important. Credit makes the world go round.
It does. This is actually a mini composite index itself. It bundles together several financial indicators reflecting credit availability and costs things like interest rate spreads, margin debt, loan officer surveys on lending standards.
So is credit getting easier or harder to get?
Basically, yes. Changes in credit conditions usually precede changes in spending and investment. Tighter credit tends to slow things down later. Okay. 2 left. Number 9. Interest rate spread, 10-year Treasury bonds, less federal funds. This is the yield curve component again, a specific version. The difference between long-term Treasury yields and the Fed's short-term policy rate.
The one that inverts before recessions?
That's the one. A narrowing spread or inversion often signals tighter financial conditions or market expectations of a future slowdown, potentially leading the Fed to cut rates later. Strong historical track record.
And finally, number 10.
The last one is average consumer expectations for business and economic conditions. This is the only pure sentiment measure. It averages answers from big consumer surveys, like the University of Michigan's and the Conference Board's own.
How people are feeling about the future.
Yep. How households expect the economy and business conditions to be down the road. If consumers are optimistic, they tend to spend more. If pessimistic, they might pull back. That influences future growth.
Wow. Okay, that's quite a mix. Labor, manufacturing, investment, housing, finance, credit, sentiment. It really touches a lot of bases.
That's the design, to capture those early signals from different corners of the economy. And remember, they use those standardization factors.
Right, to make sure the jumpy ones don't dominate.
Exactly. Based on historical volatility. So each of the 10 contributes sort of equally to the overall index move. And they do update these factors periodically.
Okay, so they build this index from 10 standardized parts. How do they actually use it to say, okay, warning lights are flashing for a recession? Is there a specific rule?
Yes, there is. They have a guideline based on what they call the 3Ds.
The 3Ds, okay.
It stands for duration, depth, and diffusion. They look for a combination of these 3 things when the LEI is falling.
All right, break down the 3Ds for us. Duration.
Duration is pretty straightforward. How long has the LEI been declining? Is it just a 1-month dip, or has it been heading south for several months? A sustained decline matters more.
Makes sense. Need a trend, not just a blip. What's depth?
Depth measures how steep the fall is. They look at the LEI's rate of change over the last 6 months, and they annualize it. The specific threshold they use for a recession signal is when that 6-month annualized growth rate drops below negative 4.1%.
Minus 4.1%. Okay, so it has to be a pretty significant rate of decline over half a year.
Right. It filters out milder slowdowns. And the third D is diffusion.
Diffusion, like
Yeah.
how spread out the weakness is.
Exactly. Is the whole index falling because just 1 or 2 components took a nosedive? Or is the weakness broad-based across most of the 10 indicators? They calculate a diffusion index, what percentage of the 10 components are falling over that same 6-month period.
Yeah.
The threshold here is at or below 50%.
So half or more of the components have to be weakening over 6 months.
Correct. So the official Conference Board recession signal, based on this rule, gets triggered when both things happen simultaneously. The 6-month diffusion index is 50% or lower, widespread weakness, and the 6-month annualized growth rate is below negative 4.1%. Significant depth.
Both conditions met, depth and diffusion, that's clear.
It provides a more robust check than just looking at the headline LEI number alone.
Okay, now for the really interesting part. What was the LEI telling us recently? You mentioned data from January and April 2025. What was the story?
Let's look at January 2025 first. The LEI actually dipped just a bit that month, 0.3%. But importantly, that came after small increases in November and December 2024.
So not a straight line down at that point.
No.
Yeah.
And looking at the crucial 6-month window ending in January, the annualized rate of decline was about -1.8%.
Minus 1.8%. Okay,
Yeah.
that's nowhere near the Megas of 4.1% threshold for depth, right?
Not even close. So the depth condition was clearly not met in January. Now, what about diffusion? How widespread was the movement?
What do the components look like?
Well, the sources said strengths actually became more widespread in January. Over the 6 months leading up to it, 6 out of the 10 components were actually advancing.
6 out of 10 were positive, so the diffusion index was 60%.
It was reported as 65% over those 6 months. So well above the 50% threshold for the diffusion part of the rule.
Okay, so January 2025, depth wasn't met. Negative 1.8%, negative makes 4.1%. Diffusion wasn't met, 65%, makes 50%. No official recession signal then.
Correct. The Conference Board's takeaway at the time was that the data suggested continued growth, however modest in the near term. Some components were up, some down, but the overall picture wasn't flashing red according to their rule.
Interesting. Now, fast forward just a few months to April 2025. Did the picture change?
Yeah, considerably. The April data show the LEI had fallen for the 5th month in a row.
5 straight months down. Okay, that clearly hits the duration aspect. What about diffusion, where the components still mix?
Not so much. The description was stark. Weakness was seen across nearly all 10 components.
Nearly all. Wow.
Yeah. While they didn't give the exact number in the source snippets we have, that language strongly implies the 6-month diffusion index was at or below 50%.
Okay, so in April, the diffusion criterion was met. Widespread weakness. That's one part of the rule triggered. What about the depth? That 6-month decline rate?
It had worsened. The sources say the LEI's 6-month growth rate declined further in April. But, and this is the key part regarding the rule, it was still slightly above the McGann of 4.1% threshold.
So it got closer, maybe down to like meta 3.8% or meta 4.0%, but didn't quite cross that line.
Exactly. It had deteriorated significantly since January. The decline was accelerating, but it hadn't officially hit that meta 4.1% mark as of the April report.
So let me recap April 2025. Duration. Definitely there. 5 months down. Diffusion. It sounds like it was met. Weakness nearly everywhere. Depth. Got very close, but technically just missed the net of 4.1% trigger.
That's the situation the April data presented, based on our sources. A much weaker trend than January, widespread component declines, pushing right up against that official recession signal, but not quite there yet.
Fascinating. It really shows how specific these rules are and how things can look pretty worrying without technically meeting the official definition, and how fast things changed in just 3 months.
It really does. And, this leads us straight into the bigger discussion about how hard this forecasting game really is, even with a tool like the LEI.
Yeah, this is where it gets really tricky, doesn't it? Because, let's be honest, economists don't have the best track record predicting recessions before they happen. One source, Forbes, I think, just flat out said no indicator is foolproof.
That's putting it mildly. The LEI is generally seen as better than flying blind or relying on just one thing, but it's absolutely not perfect. Forecasting is inherently difficult for some really fundamental reasons.
Like what? What makes it so tough?
Well, for one, think about limited historical data. How many U.S. recessions have there actually been since World War II? Only about 11.
11. That's not a lot to build statistical models on, is it?
That's a tiny sample size, really. Each recession has its own quirks, its own causes. What worked as a predictor for the last one, or the one before that, might be totally irrelevant for the next one.
And the economy itself keeps changing,
Hugely important point. The evolving structure of the economy. The U.S. economy today, dominated by services, tech, global links. It's just vastly different from the manufacturing-heavy economy of the 50s or 60s or even the 90s.
So relationships that held true back then might not apply now?
Exactly. How businesses react, how consumers behave, how global shocks transmit, it all changes. An indicator that was a reliable leader 50 years ago might be less relevant now, or its lead time might change, or it might just stop working. That's indicator instability.
Like the yield curve debate you mentioned. People wondering if it means the same thing today.
Precisely. Global money flows, central bank actions.
Yeah.
Things might be distorting that historical signal. So even a proven indicator needs constant scrutiny. You can't just assume it works forever.
So small sample size, changing economy, unstable indicators.
Yeah.
What else? What about the models forecasters use? That academic paper looked into this, right?
It did. And it had some really interesting findings about the nuts and bolts of statistical forecasting. It kind of confirmed how hard it is, even for the pros using fancy methods. One surprising thing was about data set size.
You'd think more data is always better, right?
Intuitively, yes. But they found that throwing hundreds of predictors into some models didn't necessarily make the forecasts better than using a carefully chosen smaller set, maybe 10 to 15 key variables. For some model types, like certain kinds of VARs, too much data could actually make things worse, especially if you don't have a super long history. Sort of a garbage in, garbage out risk, maybe?
Yeah.
Or overfitting.
Less is more sometimes. What else did the study find?
Model choice matters a lot. Different statistical techniques. They look at things like factor models, Midas models, different types of VARs handle data differently, especially large amounts of data. Some were better suited than others. And even within a model type, small choices about specification, like how you treat the data, could really affect the accuracy for forecasting specific things like inflation or GDP.
And it matters how far ahead you're trying to forecast.
Definitely. The forecast horizon. The best model for predicting next quarter might be different from the best model for predicting 2 years out. Makes sense, right? Different dynamics might dominate over different timescales.
They also compared different kinds of models, like structural versus purely statistical.
Yeah, model type. Structural models, like DSGEs, try to map out the economy based on theory, how households and firms should behave. The study found they could be good for certain specific long-term forecasts, like inflation in the US or UK sometimes. But their performance wasn't consistent across countries or across different time periods. They seemed to work better during stable times than during chaos.
Which is kind of when you need them most.
Isn't that the irony? Simpler statistical models, while maybe not theoretically deep, can sometimes be more flexible and better at just capturing recent patterns, even if they don't explain the why.
And even just figuring out what's happening right now, what they call nowcasting, that's hard too.
Apparently so. The study found that even using special techniques designed to blend high-frequency data, like monthly reports, into estimates for the current quarter, didn't reliably improve nowcasts for growth across the board. Getting that real-time read is surprisingly tough.
So the research really paints a picture of, well, immense difficulty, even with all the math and computing power. And then there's the stuff you just can't predict.
The curveballs, exactly. Unpredictable global events. Think about COVID-19. It just blew every standard model out of the water, right?
Totally. Everything went off the rails.
Forecasters had to scramble, start looking at totally different things, credit card swipes, restaurant bookings, cell phone location data, just trying to get any sense of the immediate impact. Wars, natural disasters, huge policy shifts. These things can just sideswipe the economy in ways no historical pattern could anticipate.
It really feels like forecasting is trying to predict the trajectory of a feather in a hurricane sometimes.
That's not a bad analogy, actually. You're working with probabilities, historical tendencies, in a system that's fundamentally complex, driven by human psychology, and constantly being hit by unexpected gusts of wind.
Okay. So we've gone deep on the LEI its parts, the 3Ds rule for recession signals, the recent weakening trend into April 2025 where it got close but didn't quite trigger. And we've looked hard at why this forecasting business is so challenging, the data limits, the changing economy, the model complexities, the wild cards. Let's tie this back to the listener, to you listening right now. Why does wading through all this complexity matter?
Well, first off, understanding tools like the LEI and knowing forecasting is hard isn't about getting a magic 8-ball. We've established that doesn't exist, right?
Right, no guarantees.
It's not about knowing the exact date a recession might start, if one even does. It's more subtle.
It's about context, perspective.
Exactly. Context and perspective. When you hear about the LEI falling or GDP numbers or inflation reports, having this background helps you understand what those numbers mean, how they're built, and crucially, what their limitations are. You can filter the news with a more critical eye.
So you're not just taking headlines at face value.
Precisely. And more specifically, watching something like the LEI, especially when you see that sustained decline and widespread weakness like we discussed for April, even if it hasn't hit the official recession signal, it acts as an early warning. A yellow flag, maybe an orange one.
A signal to pay closer attention.
Yes. And that gives you time. Time to think. Time to look at your own situation, your business, your job, your savings, your investments. Time to consider, okay, what if things slow down? How would that affect me?
And maybe make some adjustments, or at least have a plan.
Exactly. It allows you to be proactive, or at least prepared, rather than reactive when or if something actually happens. It informs your thinking, gives you a chance to position yourself.
So it's a tool to inform your own judgment, not replace it. You still need to know your own business, your own market, your own risk tolerance.
Absolutely. These indicators, these forecasts, they're inputs, important inputs, providing a view of the wider landscape, but you have to combine them with your own knowledge, your critical thinking, and the reality that the future is always uncertain. They frame possibilities, not certainties.
Okay, so summing up our deep dive on the U.S. leading economic index, it's this composite of 10 indicators aiming to lead economic turns, with the Conference Board using that 3Ds rule, duration, depth, diffusion, to signal recession risk. Recent data showed a clear weakening, hitting diffusion, but just missing the depth threshold in April 2025.
And we also saw just how hard forecasting is. Limited history, a constantly changing economy, tricky modeling issues confirmed by research, and those unpredictable global shocks that can throw everything off course.
So here's the final thought to leave you with. Given everything we've discussed, the value of the LEI as an early signal, but also the massive challenges in forecasting, the way indicators can lose their edge, the role of pure chance. How much trust should we really place in these numbers? And how do we find that balance between listening to these quantitative warnings and using our own eyes, ears, and judgment to navigate the twists and turns ahead?
That's the million-dollar question, isn't it? Requires ongoing vigilance and thought.
It certainly does. Thanks for joining us on this deep dive. We hope it's armed you with a better understanding of the LEI and the whole fascinating, frustrating world of economic forecasting. Keep asking questions.